Up. Well, we go from who will take over the top spot at AIG to whether or not this is a stock that you should be holding in your portfolio. Well, so far this year, the stock has taken quite a beating, trading down over 30%. So is it worth investing in at these levels? Joining us now, Paul Newsome, insurance analyst with Sandler O'Neill and Partners. He rates AIG a buy. And also with us is Rady. He's CIO and portfolio manager with Rady Asset Management. Great to have you both with us. Why do you like AIG right now as a buy, Paul?
I think the core businesses have a lot of value to them. I think there's an obvious sort of negative catalyst that's keeping the stock unusually low, and due to the offering itself, and that we expect from the government. And I think there's just a very inexpensive valuation. This is a stock that's trading, below 70% of book value on a pro forma basis. So.
But Paul, this isn't a short-term play, right? This is a long-term play, wouldn't you say?
And absolutely, that's a very good point. I mean, in the short term, it's going to be very difficult to tell where the stock is going to go. A lot depends upon how the re-IPO is marketed, and of course what happens with earnings, which will be complicated given the restructuring.
I mean, that's the thing. Between now and what you'd call long-term, there's an awful lot of things that could potentially go wrong or well. Harry, what do you think?
We're deep value contrarian investors, and we're always looking for stocks trading at or near their 52-week low. So this is right up our alley. We just want to get the timing right, and given all the moving parts and the sale by the government, maiden lane issue. I mean, there are lots of things to be worried about. But at 7 times forward earnings and 80% of tangible book, given the global footprint in 130 countries and jurisdictions, we think that there's real value here. But as Paul said, that you've got to have a longer term horizon. But if you do have a longer term horizon, it creates a real opportunity, because who knows what's going to happen in the next couple of quarters. But over the next couple of years, at 80% of tangible book and 7 times earnings, we think there's absolutely money to be made here.
Well, how crucial is the leadership to the outlook for this stock, Paul? I mean, Mary was just telling us there are a couple of potential contenders. Paul Hancock, Robert Miller could step in if need be. Who do you think would be best for this job?
I think it's a very important issue, and I think it's kind of an unknown for investors. I don't think anybody really knows who's going to be the next CEO. And the deep bench that we had there before, we're a little less certain of, given all the changes that have happened over the years. So I think it's an outstanding issue. It's one of the reasons why the stock is as cheap as it is.
Do you have an idea of who you would like to see at the helm, Harry?
I don't. I think that as the non-core businesses get run off and as the company gets restructured, I think then when that's largely behind them, that they'll need a different profile of CEO. But right now, I'm very happy with the job that Ben Moshe has done, and I don't see any need to replace him.
So Paul, let me pin you down. What's your price target if you do have it as a buy right now, and what's the biggest risk to your buy rating?
It's a $42 price target, and I think the biggest risk is kind of the unknowns. In the other area that there's a lot of these non-core businesses that we just don't understand very well, and it's tough to tell what exactly the cost will be to get out of them.
To both of you, thank you so much for joining us with your thoughts.
Thanks, Mandy.
And 40 minutes to